Hello, everyone, and welcome to the Main Street Finance Podcast. This is the show where I spend hundreds of dollars on equipment so that I can talk to myself alone in a dark room. I am, of course, Alex, your host, and luckily for me and you, my girlfriend is out of town this weekend, so I decided there was nothing better for me to do than to record a bonus episode for you guys. So let's strap in and talk about insurance.
You're listening to the Main Street Finance Podcast, where we take the Wall Street bull by the horns to help you achieve your financial goals. Whether it's budgeting, investing, or financial independence, we tackle the big questions in the pursuit of financial literacy. And now, your host.
Alrighty, everyone. For today's bonus episode, I just wanted to have a quick couple-minute episode. I wanted to talk about the importance of insurance in an economy. And to do that, I'm going to tell a quick story. Let's say once upon a time you have a village with 50 huts, and that every year it rains so bad it hails that 2 of the huts get destroyed. To rebuild one of these huts is going to cost about $2,000. So if all the villagers work together, they decide that, okay, it costs $2,000 to rebuild a hut, 2 get destroyed every year, so it's about a $4,000 cost to somebody every year. Instead of having it be random, the village gets together and decides, okay, we're going to all throw in some money, and then whoever it happens to be this year, they get the money to rebuild their hut. So when they break it out like that, they find out that instead of there being a risk of spending a full $2,000 to build a hut, they have to each put up $80. That's it, just $80. And if your house gets destroyed, it's you're the unlucky one, well, then you've only paid your $80, same as everybody else. So let's go ahead and let's see the same village, but without insurance. If there's no insurance, then it could be anybody that gets hit with this hail. It could be anybody that suddenly lose their hut. To mitigate that risk, what the huts all have to do is each hut has to save $2,000. Because if you lose your house, you're not going to have time to just save up and build a new hut. So each hut has to now keep $2,000 in savings just in case it's them. So what this does is if you have $2,000 for each hut, and there's 50 huts in the village, that means in this village there is $100,000 sitting around doing nothing, and no one wants to do anything with it because if you suddenly lose your hut or your house, well, then you need that money. So what happens is the local economy for this village is going to really suffer because you have $100,000 just sitting there doing nothing. So naturally, what's going to happen is it's going to be really good to have insurance because you're covered, but not only are you covered in case it's you who's the unlucky one, but the entire economy doesn't suffer because everybody's saving. That money is still available to be saved, it's there to be invested, it's there to be spent, and every time money is spent, somebody earns money, and they are going to turn around and spend money, and that money is just going to keep shifting hands, and that's the sign of a healthy economy. So, the importance of insurance is that it keeps the money flowing, and it saves you in case you're the unlucky one. And this has been our quick bonus episode. I'll see you guys Tuesday for our regularly scheduled episode on HSAs.
Thank you for listening to the Main Street Finance Podcast. Have a question on today's topics or have suggestions for future episodes? Send an email to mainstfinance@gmail.com. Sharing is caring, so if you learned something new and useful today, make sure you share with friends and family. Don't forget to like and subscribe to be notified of new episodes. For demonstrations and more examples, be sure to check out the YouTube channel. We'll see you next time.